the Great Depression, and FDR, leading into the crash of 1929. The election of 1928, Al Smith was the Democratic candidate. Al Smith was an American politician who was elected governor of New York 4 times. The Republicans won in the 1928 election, and Hoover won, defeating Smith by more than 6 million votes and carrying the Democratic states of Oklahoma, Texas, and Florida. During the 1920s, America struggled to enter the modern era. American economy was fragile. Herbert Hoover was an American engineer, businessman, and politician who served as the 31st President of the United States from 1929 to 1933. The Great Crash. Consumer goods revolution contained the seeds of its own demise. The productive capacity of the automobile and appliance industries grew faster than the demand of them. Each year after 1924, the rate of increase in the sale of cars and refrigerators slowed down, which is a consequence as more and more people already own these durable goods. Production began to plummet, and in 1927, the nation underwent a mild recession. The sale of durable goods declined, and construction of houses and buildings fell slightly. If corporate leaders had needed these warning signs, they might have responded by raising wages or lowering prices, both effective ways to stimulate purchasing power and sustain the consumer goods revolution. The Wall Street crash of 1929, also known as Black Tuesday, the Great Crash, or the stock market crash of 1929, was the most devastating stock market crash in the history and was a key factor to the Great Depression. 79 years ago, the New York Stock Exchange experienced the worst financial panic the country has ever seen. When President Calvin Coolidge delivered his 1928 State of the Union address, he noted that Americans had never met with a more pleasing prospect than what appears at the present time. Americans had a lot to be proud of back then. World War I was thoroughly behind them, radio has been invented, and automobiles were growing cheaper and more popular. The rich and poor had widened in despair with the past decade, but Americans could now buy goods on the installment plans. New concept, families could afford more than ever before. Stocks were on a tear between 1924 and 1929. The Dow Jones Industrial Average quadrupled. At that time, it was the longest bull market ever recorded. Some thought it would last forever, but in the fall of 1929, economist Irving Fisher announced that stock prices have reached what looks like a permanent plateau. More investors were pulled into the market, investing on margin with borrowed money. By 1929, 2 out of every $5 a bank loaned were used to purchase stocks. The stock market is the equity market of share market in the buyers and sellers of stocks, which represent ownership claims on a public stock exchange as well as trading. The market peaked on September 3, 1929. Steel production was down. Several banks had failed and fewer homes were being built. But few paid attention. The Dow stood at 381.17, up 27% from the previous year. Over the next few weeks, prices began to move downward. The lower they fell, the faster they pulled up speed. The Dow is a stock market index that shows how 30 large publicly owned companies based in the U.S. have traded during a standard trading session in the stock market. The last hour of trading on Thursday, October 23, 1929, stock prices began to plummet. When the closing bell rang at 3 p.m., people were shaken because no one was sure what just had happened. But the evening provided enough time for fear and panic to set in. When the market opened up again the next day, prices plunged with renewed violence in people. Stock transactions were printed on ticker tape, which produced only 285 words per minute. 13 million shares changed hands. The highest daily volume in the exchange history at the point. and the tape didn't stop running until 4 hours after the market closed. The following day, Herbert Hoover went on the radio to reassure the American people, saying the fundamental business of the country is on a sound and prosperous basis. Black Monday came around. When the opening bell rang on October 28th, prices started to drop. Huge blocks of shares changed. Companies like U.S. Steel and General Electric began to tumble. By the end of the day, the Dow had dropped 13%. Lots of shares were changed, and the traders didn't have time to record them all. They worked all night to be ready for October 29th. The opening bell was never heard on Black Tuesday because the shouts of "Sell, sell, sell" drowned it out. The first 30 minutes, 3 million shares changed, and with them, another 2 million disappeared into thin air. No one knew how much money they were losing, but they knew they were losing lots. There was a rumor that investors were jumping out of windows from how much stress and how much money they were losing. This also drove prices further down. If stockholders couldn't pay up, their stocks were sold, wiping out many investors' life savings in an instant. New York Stock Exchange Board of Governors considered closing the market, but decided against it. When the market closed at 3 p.m., more than 16.4 million shares has changed using 15,000 miles of ticker tape paper. The Dow dropped another 12%. In total, 25 billion, which is in today's world is 319 billion, was lost in the 1929 crash. Stocks continued to fall over subsequent weeks, finally bottoming out on November 13, 1929. The market recovered for a few months and went plummeting down again, sliding so bad down that it led to the Great Depression. Companies incurred the huge layoffs, unemployment skyrocketed, wages plummeted, and the economy went into a downward fall. While World War I helped pull the country out of a depression, by the early 1940s, the stock market wouldn't recover to its pre-crash numbers until 1954. So a summary of the crash of 1929. During the mid to late 1920s, the stock market in the United States underwent rapid expansion. It continued for the first 6 months following President Herbert Hoover's inauguration in January 1929. The prices of stocks soared to fantastic heights in the Great Hoover Bull Market. And in the public, from banking and industrial to chauffeurs and cooks, rushed to brokers to invest their surplus or their savings in securities, which they could sell at a profit high. Billions of dollars were drawn from the banks into Wall Street for brokers' loans to carry margin accounts. People sold their Liberty bonds and mortgaged their homes to pour their cash into the stock market. In the midsummer of 1929, some 300 million shares of stocks were being carried on margin, pushing the Dow Jones Industrial Average to a peak of 381 points in September. Panic began again on Black Monday, October 28th, with the market closing down 12.8%. On Black Tuesday, October 29th, more than 16 million shares were traded. The Dow Jones Industrial Average lost another 12% and closed at 198. A drop of 183 points in the less than 2 months. General Electric fell from 396 on September 3rd to 210 on October 29th. American Telephone and Telegraph dropped 100 points. DuPont from 217 to 80. United States Steel from 261 to 166. Delaware and Hudson fell 224 to 141. And Radio Corporation of America fell from 505 to a drastic 26. Political and financial leaders were first affected to treat the matters as a spasm in the market, which they considered just a couple months of a downfall. But President Hoover and Treasury Secretary Andrew W. Mellon led the way with optimistic predictions that business was fundamentally sound and that a great revival of prosperity was just around the corner. Although the Dow Jones Industrial Average nearly reached the 300 mark again in 1930, it sank again in May 1930. Another 20 years would pass before the Dow average regained enough momentum to surpass the 200-point level. Many factors caused the crash: tightening of credit by the Federal Reserve, the proliferation of holding companies and investment trusts, a multitude of large bank loans that couldn't be liquidated, and an economic recession that had begun early in the summer.